And now, with sound investing, here's Paul Merriman.
Well, welcome to what I think is going to be one of the most interesting podcasts and videos that we've ever done. I am so excited. As a matter of fact, there's two reasons why I'm excited about this today, because we're going to be talking about how to help a young person get started, whether it's a young person at birth or a young person at 18 or 21. In fact, we'll share a couple stories about people who have already done what we're going to talk about here. And the reason is pretty exciting to me is because I just found out that in a few months I'm about to become a grandfather of a granddaughter who I am going to do for her what we're going to talk about today. So this is exciting to me. And normally I would probably take this on by myself and go through my sales pitch, but I thought it would be more meaningful if Chris Pedersen and Daryl Balls. Chris is for newcomers, our director of research, and Daryl is our director of analytics. These two people volunteer hundreds and hundreds of hours a year to the foundation. Daryl is responsible for creating and building some 160 plus tables. And Chris not only does table work, but he also goes through and creates the best in class ETFs. So these people, unpaid volunteers, are working for you as hard as they can. I'm in the same boat. I'm just not as smart about the kinds of things that they do. But I have, of course, the optimism and the mission to make sure that we do all we can to make you a better investor. And in particular, we're trying to help the do-it-yourselfer. Somebody who's got an advisor, that advisor is going to be telling a different story than we do, more than likely. But we are here to help the do-it-yourself investor. So let's talk about today. We are talking about putting money aside, either for a young person or the young person doing it for themselves. I spoke a couple of days ago to about 100 Western Washington University students, and I talked about this strategy to try to get them excited about how important it is to take advantage of the very early years of investing. And you're going to see something pretty neat here, because you're going to see that first 5 years early on could, in fact, for some people, would be maybe all they needed to invest. But we're not going to recommend that. But I think you're going to be interested in how this all plays out over the long term. And by the way, we have to understand the long term is different today than it used to be. 1947, I would have had expected, if I was born in 47, I wasn't, I was born in 43, but I just read the article that talked about those born in 1947. They have to expect to have money until 2117 to live on. That's a long time. And that is because today, a child that's being born is going to have a 50-50 chance that it will live to at least 103. And by the way, that's an American. If you're Japanese, it's 107. So that means you spend a lot of years in retirement. And as a caring parent and grandparent, or a savvy young person, this means that we've got to make sure that we have not just enough, but more than enough to last for potentially a lot of years. So I asked Daryl, could you put together something that would show us the impact of some early years? Let's just say the first 5 years of a person. I'm talking when they get, let's say they get out of college, but that first 5 years that they make a commitment to something that is fairly aggressive, and they make that commitment for life. And by the way, for life is not an unusual thing for a lot of investors to do. A lot of investors invested in Coca-Cola for life. They invested in, well, unfortunately, Sears Roebuck for life. And so there are great stories of people who invested for life in some equity security. And there are some horrific stories about people who invested in companies that didn't make it. And you know how we feel. We only want you to invest in life in something that we believe the probability of success over the long term is very, very high. And just this morning or yesterday afternoon, Chris laid another table out there about the probabilities of this working that he will be sharing here today that I hope, give you the sense that this is doable and something worth taking the risk that we're talking about. So, Daryl, could you give us your table? And could you give us a few words when I said, could you put together a table, how you did it and what it shows?
Sure. Let me bring up the screen here. What would happen if somebody only invested the first 5 years of their career, let's say, when they get out of college or when they start working to make a little money or something like that? And so, and if they were able to earn 12% a year, tax-free in a Roth, let's say. So I did that. I looked at putting in 5 years worth of $6,000 a year into a Roth IRA or a Roth 401k with no match, or a Roth 401k with a 50% match from your employer. And do that for 5 years. And then stop contributions. And then when you retire at 65, start taking them out. And you do that, take 5% out every year, 5% of the previous year's balance. And you do that until age 95. So what do you end up with at the end of 95? How much were you able to, or at the end at 95, how much were you able to take out during those 30 retirement years? And what was the total benefit, the sum of those two, of your withdrawals and what you have left at the end that you can pass on? So the bottom line is that if you do this and you can earn 12% a year, you're probably going to be in pretty good shape. The Roth IRA, at the end of 5 years, you have about $42,000. That's what your investment is worth at the end of those first 5 years. And by retirement, it grows to about $3.5 million. We're down here right now. And so you start taking out 5% of that at age 65. And by the time you reach 95, you've taken out $15 million. And your portfolio was worth $22 million still. So your total benefit was almost $38 million. So that's pretty good for a $30,000 investment in your early 20s. If you have a Roth 401k, the scenario is very similar. You don't have quite as much money at the starting point when you stop making contributions, because you've essentially put them in on a monthly basis rather than all at the beginning of the year. But still, you end up with 36 million. Here though is the real kicker. When you're going and looking for an employer, if you can find one that will match your contributions, that really supercharges things, because you end up with essentially with a 50% match. You end up with essentially 50%, and you end up with 54 million at the end. But in the meantime, you've taken out $21 million during your 30-year retirement. You have almost a little over 32 million left at the end. So these are all nominal dollars. And so a loaf of bread now might cost a few bucks, but it might cost 50 by the time you're 90 years old. Okay, so does that mean anything? You know, what do these numbers mean? What does it mean in terms of what you could really buy? Okay, so the next thing we did was we took every year's worth of contributions and withdrawals, and we adjusted them back to what their value would have been at age 21. So these are real age 21 when this scenario started, real age $21. And you can see the numbers here. They're a lot smaller, which of course you would expect. But these are in terms of what you would have to spend today, what you could buy today. So you still have $5 million, $7 million total benefit. Take out $2.5 million or $3.5 million during your retirement over 30 years. That's a good chunk of change. This averages out to, for example, here, that's $100,000 a year, almost a little more actually, average over the 30 years of retirement for the 401k match. That's in today's dollars, age $21 when you start this program. That's a reasonable amount to live on at that point. If you start early, you can really have a much more dramatic impact on your ability to retire with confidence at a point 40 years later at 65.
And of course, Daryl, the things that really kind of caught my attention. The first one is when you're talking about a young person and you're talking about building, whether it's in nominal or real dollars, a multi-million-dollar retirement based on this one series of $5,000 or $6,000 investments over 5 years. They're going to be judging this early on and asking themselves, does this feel like I'm on my way to being a multimillionaire? Well, I can tell you at the end of 5 years, they probably don't feel like a multimillionaire because they've put in $30,000 and the market has made another $12,000 approximately. And this is such an important lesson for young people. And that is that this is truly a partnership. And in the early years, you, the investor, are the important partner. It's not the market. After a point in time, the market becomes the more important partner in this relationship. And so it just takes a time. And the important thing is to figure out a way to explain that to young people and get them to have the confidence. Because as far as I'm concerned, the biggest risk of this not happening doesn't have to do with the market. It is the discipline that you are able to help that young person build. And I'll share a few stories in a few minutes. Now, it's not going to shock anybody to find out that what we think you could over a long period of time make 12% is in the small cap value equity asset class. And the beauty of that, from my viewpoint, is we're not depending on a Coca-Cola or a General Motors or a Sears Roebuck. We are depending upon an asset class that has a history that has been as successful or more successful than probably at least 95% of the public companies that ever came on the market. Because it's been a very small handful of companies that have been able to compound at more than a 10% compound rate of return. Not even Coca-Cola did. Well, if you add dividends, they did. But if you didn't add the dividends, they did not, as it turned out. So my belief is that the probabilities are pretty good with small cap value. And of course, Chris was kind enough to build another table and to look at least based on history, what the probabilities are of that small cap value asset class actually making that 12%. Chris, do you have the ability to, well, maybe before I ask for the new table, what comments would you have that about this table that we've not mentioned yet?
Well, I think it's a great example of buy right, hold tight, don't peak. So, one of the tricky things about buying right, especially if you're going to hold tight and not peak, is that you need an asset that's going to effectively be managed. If you bought a stock portfolio, you'd have to look at it periodically and figure out which companies were in trouble, which ones weren't in trouble, what to buy, what to sell over time. If you buy a small cap value index fund that has low costs and gives you good exposure to those parts of the market, there's somebody doing all that work for you. They're doing the work to make sure that it stays a small value fund, that it meets its cost objectives, that it's managed tax efficiently. And over a lifetime, it'll probably change hands. It probably won't be the same company across a lifetime, but a lot of times when a fund goes out of business, it gets subsumed into another like fund. And if worst came to worst in a tax deferred account like a Roth, you would sell it and buy a different one. You'd stay in the same asset class. So it's just a great way to do this just wonderful approach of buying something that's got reasonable historical expectations, and then give yourself permission to look away and just hold it and ignore the ups and downs in the market, and then be pleasantly surprised when it comes time to tap it. So I think it's a great example of something that a young person could do, and I think it's probably easier for a young person to do with help. You said you were going to try and set this up for your granddaughter. I think it's easier for somebody to ignore an investment or respect the fact that it's been set aside for the future when it was given to them with that intent. I see that in my own kids. The money that they make on their own has a different mental accounting than money that we've helped them with. The money that we've helped them with, they have a certain respect for its intent and what it will do in the long run. And I think they're just a little bit more hesitant to spend it, and that's a good thing.
Well, I would add a story about one of the folks has been kind enough to support our foundation, and this gentleman, for several of his nieces and nephews, has helped them get started. And in the article that's coming out next week about this strategy, we tell the story about what he did. We call him Kevin, and his niece's name in the article is Madison. Those are made up, but the dollars aren't. And he is funding for a 5-year period the $6,000 a year. By the way, if it was $1,000 a year, that would be okay too, or even 500. Any amount is going to make a difference over the long term. But he asks for 3 promises, and I love what he's done. He says the first promise is that they're going to read. In fact, he recommends she read We're Talking Millions, 12 Simple Ways to Supercharge Your Retirement. By the way, for everybody who wants a copy, all they have to do is paulmerriman.com/sign up, and you'll get a free PDF that we hope you'll send to all sorts of your friends. But that's step number 1. Step number 2 is that she cannot cash this out until she is 60 or more. And number 3 is that she has to do this for somebody later in her life and help somebody get started. And interestingly, somebody else who this gentleman did this with had given money, and that person got in trouble financially and really struggled, but that person never cashed out the money that this gentleman, Kevin, had given to them because they had made this promise. So I really think the real challenge is figure out how do we get this kind of commitment. Well, I think, Chris, those numbers that you have, and if you can, does Daryl have to stop and
Yeah.
give it back to you?
Yeah,
If you-
Daryl needs to unshare and then I can share.
No.
Yeah,
Great.
good.
Because this table, I think, would give anyone hope that this is not just a wild dream.
So what Daryl did was based on assuming a 12% return, and what I was interested in was using the historical returns that small cap value has actually generated. And so I went to Portfolio Visualizer and ran a Monte Carlo simulation. And for people interested in how to do that, I will do a short tutorial that we can either tack at the end of this or do as a separate podcast to show you how to enter everything to make it work. But one of the things that produces is a probability of getting returns greater than a certain amount at different points in time along the journey. And you can set the returns that you want to test for. And since I knew that small cap value, this is US small cap value, has a high historical return rate, I set the returns at 0%. So anything greater than 0 means you haven't lost money. 8%, 10, 12, 13, and 14. And so if you look at, the probability of not having lost money at 1 year, there's about a 25% chance you've actually lost money. And that's the scary thing about putting anybody in this kind of a plan, is that they'll peak at a year and they'll learn the wrong lesson, right? They'll learn that, oh, I can't trust that asset class because it lost me money in a year. But if you looked at 5 years, there's only about a 5 to 6% chance that you lost money. At 10 years, it's 0.2% based on history and this Monte Carlo simulation. And by the time you get out to 20 years and beyond, there was no historical sequence of returns that produce a loss. Now, that's interesting. We don't want to lose money, but the other end of things is also interesting. Daryl modeled a 12% return. So what are the chances that somebody would really get a 12% return over, let's go out to 40 years. At 40 years, it's about a 75% chance they would get that. What are the chances they'd get a 14% return? Because historically, over the period of time that this asset class was tested here, 1972 to 2021, the CAGR for small cap value was actually 14%. Well, at 40 years, the odds of getting more than 14% after expenses with dividends reinvested is right around 50%. So, is there a guarantee? No. Does past performance guarantee future performance? No. But does the history suggest that this is a prudent strategy with a high likelihood of future success? Yes. Yeah, I think it does. And so I take some comfort in this. And like I said, for people interested in how to run it, I'll do a little tutorial and we can put that up too.
I think that's great information, Chris. And probabilities are always what we're focusing on because we don't know the future. And this is, I think, a very thoughtful look back. What one might ask is how normal the last 52 years or whatever 50 years that you have here, how normal that is. And if I'm not mistaken, when we go back to 1928, the average 40-year return for the S&P 500 is 11%. And over the last 52 years, we've gotten 11%. Now, the small cap value average is about 16% going back to 1928. And what you're noting is it was 14% over the last 50 years instead of 16%. So it may be that the premiums in the future for small cap value won't be as great as they've been in the past. In fact, that's more than likely going to be the case compared to the S&P 500. But it does look at least as if that we could get that 12%. And of course, we're assuming the S&P 500 is going to be able to get 10. I think from Daryl's work on the 50-50 S&P 500 and the small cap value during this period of time, that was a 12.7% compound rate of return, as I remember from his table. So even that could potentially, in fact, it would be interesting when we have time in the future to run this kind of a question about that 50-50 strategy for people who are uncomfortable with the idea of putting their money in small cap value for the rest of their life. And by the way, we are talking about the rest of your life. We're not suggesting that money above and beyond this original $30,000 or $15,000, whatever you might be able to put away. We're not suggesting that you do everything this way. We are suggesting you consider this particular piece of the pie to be an equities forever strategy. And again, that is not unusual, although obviously what we teach is that when you're 50 and 60, you start adding bonds to the portfolio. Well, that could be with the rest of your portfolio. So, I mean, just for a second, Chris, because you've done all that work with 2 funds for life, let's say that a young person does this aggressive, all small cap value, and puts that there for the rest of their existence. What would you suggest? How would you get them to form their plans for the period following this first 5 years?
Well, I think that they have a lot of different choices. I like the idea that people have something in their portfolio that reduces risk as they approach retirement, because our behavioral capacity and our financial capacity, just time and money to overcome problems declines as we get older. And so I think it's prudent for everybody to have part of their allocation either in a glide path they manage themselves, where they're increasing their bond allocation as they approach retirement, or in a target date fund. And I'm a big fan of the target date fund because it's simple, and odds are a lot of young people will be defaulted into it in their 401k anyway. Mm-hmm. So if somebody has this starter nest egg in small cap value, and then they started investing in the target date fund, they could just go with that. Or if they want to, they could follow a 2 funds for life strategy, and they could allocate. The simplest thing is, if they're saving 10% per year, you put 9 pennies out of every dollar into the target date fund and 1 penny into small cap value. So you're continuing to increase your exposure to this asset class with a higher expected return. Or they could use one of the age scaled approaches that I have in the book. And in fact, the aggressive one kind of looks like this, because it starts out 100% in small cap value. So they've already started out 100% in small cap value. And then it increases the allocation to the target date fund over time. And I think any of those strategies are prudent and possible, and it really comes down to personal preference and tolerance for risk and willingness to manage things along the way. Because if you're managing a glide path, you have to do some rebalancing along the way. If you're just doing the fixed allocation, it's easier to look away and just have it all be on autopilot. But all of the back testing I've done says that in the accumulation years, it's going to help people take a little bit more risk when they can in the early years, and have more in retirement if they allocate some to small cap value. And if they continue to allocate some to small cap value in retirement, it will increase the risk, but it will increase the volatility, but will actually decrease the risk of running out of money, because it increases the safe withdrawal rate. So it's one of those weird things where it looks riskier because you have to tolerate a bumpier ride, but it's actually less risky because if you tolerate it with discipline, you're less likely to run out of money and more likely to be able to spend more while you're alive. So it's
So you do this first 5 years, small cap value, and then you could go to a target date fund, which, by the way, you would, at least historically, I think your studies show what, 8.5% without adding any small cap value?
that sounds about right. The other way to look at it is if you look at the expected lifetime return for somebody who just saved in a target date fund in real terms, so correcting for inflation and looking at their spending power, if somebody saves 10% into the target date fund across a 40-year career and then takes out 4% fixed withdrawals in retirement, it doubles their lifetime spending power, the expected lifetime spending power historically, which is amazing. You just think about that simple decision and two people sitting at their desks and one of them makes the decision and the other one doesn't. And the one who doesn't make the decision to save for the future has this headwind. It's like you spend your whole life with half as much spending power. It doesn't seem fair, but it's the way it, at least it historically played out. Yeah.
And Gerald, what about you? In fact, you guided some young people. What would be the next step beyond this small cap value commitment?
I think if we think about the 5-year study that we showed earlier, and the work that Chris showed, if you set that aside as a equity only portion, you have said many times in the past the advantages that accrue to you by oversaving. So if you if you start this program off in your first 5 years with the small cap value Roth 401k, let's say, and then you supplement that, and it doesn't, at that point, it wouldn't have to be $6,000 a year. But if you supplement it after that with your other portfolio that maybe is in a 2 funds for life, and maybe not a real aggressive 2 funds for life, if you want to keep that a more conservative investment, and marry those two together, I think you have it's a 1-2 punch that can get you to the point to where you have oversaved, and that's not necessarily a bad thing, as you've said in the past. And so I think this combination of an all small cap value, it's almost what Chris has anyway with his, like, I think he mentioned this even, it's almost like what he has with his aggressive 2 funds for life strategy. It's a little bit, it's slightly different, but it's essentially the same thing. And that approach, I think, can bear great fruit by the time you retire. We had mentioned earlier that how do you get people to realize that their little amount that they put in may or may not seem like very much. But I think one of the things that I've seen happen with younger investors is that at some point, if you do peak once a year, let's say, and you look at your portfolio, at some point you'll realize that the portfolio made more than you did in 1 year. And when that happens, that's kind of when the light bulb goes on and says, oh, wait, this may be a good thing. It takes a while to get there. But that's both the frustration and the good side, I guess, of compounding investments. So if you can get through that first decade or two and start to see how the growth starts to approach or top what your salary or your income is for a given year, then I think you're home free at that point.
Well, and the other thing I think we should mention to young people, is that that first 5 years, you're going to draw all sorts of conclusions as to whether what you just experienced was good for you or bad for you, if you want to put it in good and bad terms. So let's say it looks like 1995 to 1999, where the S&P 500 compounded at 17% plus, and small cap value compounded at 22% plus. Now, that would be a giant home run. And you would probably have a commitment for life then, that this is what you are going to do, because you're off and running and there's no question. As a matter of fact, you've doubled what we talked about here in this conversation. But the other side of that coin, and it's hard for young people to get this, if instead of 5 great years, they went through 5 horrible years, I know how they're feeling. But the reality is, if the long-term market that is a series of cycles of up and down and a lot of sideways, if in fact you're going to have to go through those difficult times, what a wonderful time to be able to buy lots of cheap shares for the future that you're going to hold for another, 80 years potentially or something. So even bad results are in fact good results. And the other thing that I want to focus on for a second is the amount of money to invest. What I'm going to do for my granddaughter is put a little money away on a regular basis and get her up to the point where she will have enough money that it will fund that first 5 years. How much do I need to put away each month? It's about $25. And if I put $25 a month, and you could do that, you can do that at Fidelity, you can do that at Schwab. They have no minimums. And if you did, in fact, get a 12% compound rate of return, that would, at age 21, cover the first 5 years of $6,000 contributions. In fact, I think you'd even have a little extra left over for almost one more year. And so this is not a matter of having a whole lot of money. I mean, again, here's teamwork. I made the comment that there's this partnership between this young adult and the market. And it's a lifetime partnership, but I'm talking now about one more partnership, and that's grandma and grandpa or mom and dad. They are a partner for a period of time until that then young person takes what they have thrown into the kitty and they move it forward to the next step, where it becomes in partnership with Mr. Market, as Benjamin Graham called it. And then it hopefully works. And I think it's also important for young people to realize there are a lot of folks who look at the future and they say, this is grim. Whether we're talking climate change or political struggles or economic or the pandemic, whatever it is, it can feel like this just isn't the way it's supposed to be. The part that's the reality is, if we go back and we recreate history, for example, starting in 1928, how do you think that turned out? Well, as a matter of fact, one of the best 40-year periods in the market started in 1933. The very best 40-year period started in 1950. But right at the depth of that depression was a point at time which, from that point on, you made tons of money compared to what you expected, because what you were in the middle of was a depression. So this don't peak, you guys are right on. And the reason you don't peak is because when you peak, you start putting all these stories we have in our head about what's going on in our life, what's going on in the country's life, what's going on in the world's life. and start having that color our thinking. And then we become market timers instead of buy and holders. And we really want you to turn all of that noise. It's real noise. It's not like it's meaningless information, but it has little to do with that long-term commitment. So I just think this has got all sorts of potential. And Chris, you've done a little bit of this already in your family, and Daryl, you've done this with your family. And I have. Some people know that I did podcasts and articles about a strategy that for each of my grandkids, I put away $10,000 into a crummy trust. That's the legal name for it. And that money then was untouchable for them until they're 65. And that was then invested in a tax-deferred, variable, no load, variable annuity so that it would compound without taxation for 65 until they're 65, at which point they legally, according to the crummy trust, are allowed to take money out every year. By the way, that money would be very taxable money. And as I think it through and look at where we are today with what we have available, I actually think I like the idea of a tax-free strategy. The only problem is I can't wrap it with a trust that requires that they can't touch it, guarantees they can't touch it, unless they figure out a way to cheat. They're not supposed to be able to touch it. And we can't do that with a Roth IRA. Once it is in their account, it's their money. Now, I understand you can't open a Roth IRA when you're a newborn child. There are actually ways you could, but few people will ever do this because you could legally pay a newborn child to be a model for some sort of a catalog house, and they could receive compensation, and they could then put that money, or their parents could match that money and put it in a Roth IRA. But under normal conditions, we've got to wait until the child, in fact, has some reportable income. It could come from mowing lawns. You cannot, I don't give tax advice, you cannot use now here's one of these old folks moments. Daryl, tell me please what they call it when a parent gives an allowance. There we go, it came back to me. An allowance. You cannot use an allowance, but you can dictate that if you mow the lawn, we will pay you $10. And that $10, according to accountants, is in fact legal income that can be used to put into an IRA. And you can match it. They don't have to put their $10. You can put the $10 in. So that does mean that for many people, before the child is earning any money, that money that's building there might throw off a few taxable dollars in reportable income for you as the parent if you keep this in your account. But I want you to keep it segregated so that you know that money is for that child or that grandchild. So there are a few little things we have to do, but the payoff is just gigantic, I think, over time. And I will be criticized for these kinds of strategies. They'll say, that's an awfully long time. I mean, why would you want to do that? Well, because the whole idea with investing is to figure out a way to invest for a really long time and have it grow, and to have it grow tax-free. Who knows what the tax rate's going to be when these young people reach 65? It could be that it will be like when I came into the business in 1966, and marginal tax rates were 70%. The previous year, they were 90%. What a joy. I mean, this is not like we're cheating the government. It's just, this is their way of encouraging us to save for the future. What a joy to be able to take out all those dollars in Daryl's table and not have to pay a penny. And the other thing that I'll say, and we're going to talk about this another time. You may think that we're creating more than enough for these kids, and maybe they don't need more than enough. I recently was interviewed by a Boglehead fellow who runs the Boglehead San Diego chapter, John Lusk. And I made the comment, I want people who are working with the information that we provide to end up with more than enough. John Bogle always said enough should be the goal. And the reason I say more than enough does not have to do with greed, avarice. It is because we have goals, we have expectations. Most people who invest are optimistic by nature. And optimistic people often see life through rose-colored glasses. And then real life pops up and you have to face it. And sometimes real life does things to people that they just weren't expecting. And so the enough that they thought would get them where they wanted to go was not enough. And so my mantra really is, we want you to make more than enough. If that means, like my wife and I are able to do, that you can give away to others. Chris, I know how you feel. Daryl, I know how you feel about this. That ability to give away often comes because you by chance ended up with more than enough. So yeah, we may be helping some kid that's not going to need a lot of extra, have more than they need. Hopefully they will follow us in terms of setting some sort of a history of integrity and a commitment to helping others. That would be nice. So I'm going to rejoice that they end up with more than enough, because I'm optimistic that your kids, your grandkids are going to be good people and good things for other people. And I'm happy that because of the work that the three of us and Craig Apple, who developed the Merriman Lifetime Investment Calculator. And by the way, can you see using that calculator to do some work to see what might happen with this strategy? What do you know, Chris, you've worked long and hard on it. You think it would be a good place to go to test this strategy?
Yeah, I think you could do some work similar to what Daryl did. The tricky part is that so far it doesn't have the ability to automatically generate a lot of different scenarios. So you'd have to iterate yourself and kind of play with it and say, you know, what happens if I start this year? What happens if I start that year? And find some lucky and unlucky scenarios. But the fact that it's the straight up real history is somewhat comforting. And I think a lot of people could learn something using it for that.
Great. Well, do either one of you have anything to add? That just look at my list and make sure that I think we've hit most of the. Chris, you're going to do your follow-up piece.
Yep, I'll do my follow-up. I guess I would just add that you know, saving just enough sounds like the right thing to do, but in practice, it's just not possible. I had a friend of mine say, you know, these strategies that you're recommending to me, they all mean I'm going to die and leave somebody a bunch of money. You know, I just want to spend it all and then die without any. And I said, well, tell me when you're going to die and we'll come up with the right strategy. You know, you don't know. And so the truth is, almost everyone who makes it to the end financially secure is going to have more than enough, because otherwise you'd die broke, and there's no way to plan for that. Yeah.
Great comment. Daryl, thank you for all the work you did on this table. Again, I think that table is going to inspire a whole bunch of people. And do you have any comment you want to add?
Well, I think Chris and you are spot on when saying you should target more than enough, because you never know what enough is. I have friends who have parents who I don't think they ever thought they would live to their mid-90s, but they have, and the bank balances are trending downward, and it's not clear that they have enough.
Yeah.
And so, the ability to extend your lifetime is becoming, I wouldn't necessarily say easier and easier, but it's becoming possible that your life expectancy and your lifetime, the probability that you will live to old age, is potentially going to increase in the future here. And so I think you need to be careful with the scenario that you plan for. A long time ago, decades ago, a couple decades ago, you planned for maybe 90, and then it was 95, and maybe now you should plan just in case for 100. What's it going to be in the future? And so nobody knows. And that's why, as much as I respect John Bogle, obviously, he's right. Enough is enough. It's just that you don't know what enough is. And so I think you have to be your own fiduciary when you're putting your plan together, and do what's the prudent thing. And I think the strategies that we've talked about here today with the chart that I showed and the study that Chris showed gives you a chance to do that, especially if you can combine things in a prudent way. As you mentioned, with your all equity and with the 2 funds for life, you have an aggressive strategy, a more conservative strategy, let's say. I think the odds of success are maybe good enough.
And I think there are parents who may not want, or grandparents may not want to give this money now. There is one thing about this strategy. If you made a gift, if it in fact it was a real gift of this 5-year commitment, whether it's $1,000 a year or $500 a year or $6,000, the fact is you have just given your child or grandchild something that could legitimately be worth millions and millions of dollars. And it may be that you won't have an opportunity to leave them much, but if you have left this, you certainly should not have a feeling that you haven't lived up to the expectations of the family. I mean, you will have hit a home run. And for those who don't believe in giving this kind of money to young people, let me suggest you sit them down and say, hey, kid, I got an idea. I want to loan you money over the next 5 years. I want to loan you money so you can do something that I understand you can't do on your own. But it's just not my idea that you give money to kids. You make them earn it. But what I know is that if I loan you this money, $6,000, $3,000, whatever it is, and you are going to pay me 5%, I'm not going to want any money until at the end of this 5-year period. And then I want you to pay me off over, I don't know, 20 years, 30 years, whatever it is. It'll be the biggest payoff you as a bondholder will ever have, because you are turning, you're going to get your profit. Your kid's not going to be given anything, but that child is going to ride a wave. Of course, it depends on the future of this country, no question. But with all the tough hurdles we've had in the past, we've carried forward, and it always feels like it can't get any worse, but it carries forward. And I think the three of us and people who invest for the long time are investing with the confidence it will, in fact, make it. So I hope some of what we've talked about today will be helpful. I am so thankful, and I just can't express this enough. Thankful for Chris and Daryl and Craig and all of those people and the folks that have donated money. We are a 501c3 organization, so it is tax deductible if you qualify for that. But the best thing you can do for us, the very best thing you can do, is pass the work that we do along to others. It's an email away if you think it's information that would be helpful. And Chris, of course, has his new book, relatively new. And I know the reviews there are very good. I've read them, every one of them, Chris, and you had a couple people who didn't like to go as deep into the topic as you went, but that's what people need to have when it's a lifetime strategy that is as important as what you have included in your book, Two Funds for Life. And of course, we want to get this, we're talking millions, into the hands of as many people, which is why we make it free with the PDF. And oh, by the way, just as Chris and Daryl, they volunteer all these hours, every penny of profit that is made on the sale of any of the books that are being sold, from any of us, it all goes to the foundation, not a penny to us. We are here committed time and money to this outreach program and help pass it on. And thanks guys. And we'll be back. Got lots more coming up, some hot stuff next week. We'll see you. And oh, by the way, let's see, will you have a chance? Nope, you're not going to get this before I do my Sacramento presentation. I'm sorry. But we'll check in as to when we're going to be making any public presentations or Zoom pieces. Chris, have you got anything coming up? I know you're going to have a release of Katie's interview of you soon.
We did, yeah. That Money with Katie podcast came out this last Wednesday.
Oh, great! And so, can they go listen to that?
I believe so. Yeah.
Okay, great. Well, you know what we'll do? If it's up now, we'll have a link in the notes to this podcast, and that'd be great. Look forward to hearing that. I have not heard it myself, so. Okay, guys, take care, keep up the good work, and stay well. And to you too, dedicated students, good luck.
Paul Merriman with Sound Investing. Sound Investing, soundinvesting.com, and paulmerriman.com are produced and exclusively owned by Paul Merriman, who is solely responsible for their content. For more information, free articles, mutual fund recommendations, and more, visit paulmerriman.com.